Okay, problem 35A is a review and a wrap up of everything we've talked about. We start with a trial balance, and they tell us that this is the adjusted trial balance, and this is from page 153 of the text. Okay, so this is the Chiara Company, and it's on page 153. And they say this is the adjusted trial balance. And as you remember from the last problem, the adjusted trial balance is where we start to make the financial statements. And again, just to keep in mind, keep things fresh, these items are all income statement: fees, interest earned, and all expenses. All revenue minus all expense equals net income. And again, that goes through our little funnel to retained earnings. The next piece right here is our equity section, and we need to add our retained earnings to the existing retained earnings to get the current balance, and the balance of the accounts, our balance sheet. So from unearned fees up, these are all balance sheet accounts. Again, remember in my class, BS stands for balance sheet. So, given those numbers, it asks us to create an income statement, a statement of retained earnings, and a balance sheet. Just to make life easy, I just folded this in half so we can refer to both. So, we need to get our fees earned, which we have right there, $484,000. Our interest earned of $24,000. And that's our total revenues. And keep in mind, if they had 5 or 6 or 7 other forms of revenue, we would add those all together and just list those as total revenue or revenues, depending on how you like it. Up where I am, revenue and revenuer means something completely different. Okay, now we're going to take a look at our expenses. And when we're looking at the automobile and the equipment, we're not looking at the expense, we're looking at the depreciation expense. So depreciation expense for the automobiles is $26,000, and for equipment, $18,000. Our salary expense is $188,000. Our wage expense is $40,000. Now that may give some of you pause, thinking that salaries and wages are the same. Many companies keep them separate. Salaries are annual fees, wages are hourly. Some companies put them together, some keep them separate. Then we have our interest expense, $32,000. And again, just to remind you, I'm just coming down this list right here from the adjusted trial balance of all of the expenses. Then I have office supply expense of $34,000. You notice I can't draw a straight line even with a ruler. That's kind of pathetic. Advertising expense, $58,000. Repair expense to automobiles, $24,800. This is repairing existing automobiles, not buying new ones. We'll add up our total expenses. We come up to $420,800. 420 subtracted from the 508 gives us 87,200. Remember, that's owned by the owners. That's part of their owner's equity. So that comes to retained earnings. And again, we're going to go back to the adjusted trial balance and pick up the beginning retained earnings. We're going to pick up any outstanding dividends. We're going to pick up common stock and any long-term notes payable. I'm sorry, not long-term notes payable. If there were dividends payable, and there were not. So, we have our beginning retained earnings of $235,800. That was from the beginning of last year. This year we earned $87,200. That gives us a subtotal of $323,000. We had dividends this year that we paid of $46,000. And how do we know we paid them? We have no dividends payable account. And even if we hadn't paid them and did have a dividends payable account, we would still reduce retained earnings by that amount. So our ending retained earnings is $277,000. And the way you can prove that is subtract the dividends from the net income and add to retained earnings, and you should come up with your ending retained earnings. So that's the statement of retained earnings. And the last thing it asks us to do is to create a balance sheet. And again, on the balance sheet, we're going to go back to the same trial balance and pick up the terms or the amounts, keeping in mind on a balance sheet, an income statement, and a statement of owner's equity, you do not use the terms debit and credit. So, and you know where the numbers are coming from, so I'm not going to keep flipping back and forth. I don't want to make you seasick. So, our cash, and let me get my notes, or God knows what numbers I'll be putting down there. They will not be the correct ones, I assure you. Okay, our cash for the balance sheet is $30,000. Our accounts receivable from the adjusted trial balance for the balance sheet is $52,000. Our interest receivable from the adjusted trial balance is $18,000. Our notes receivable due in 90 days. That means it's a current receivable, not a long-term asset, but a current asset. Notes receivable due in 90 days, $168,000. And let's take a look at that. Suppose they said $68,000 was due now, and $100,000 a year from now. We would put $60,000 in current assets and $100,000 in long-term assets or non-current assets. Our office supplies are $16,000. Now our automobiles and our equipment, we have accumulated depreciation, and we show them separately. So we have $168,000 for the automobiles, but we have $50,000 of accumulated depreciation. We show the automobiles at net which is $113,000. We're going to do the same thing with the equipment. The equipment was what's the equipment? 120,000, 138,000. 138,000 for the equipment. The accumulated depreciation was 18,000. We're going to show the equipment net of depreciation of 120,000. Land we have at 78,000. Land, by the way, never depreciates. And the reason for that is really very simple. Depreciation is a function of time, and it estimates how much of the asset's life you have used up. Well, what's the life of a piece of land? I mean, what would be the lifespan of, I don't know, New Jersey? So, our total assets, we add those up, 600,000. Now, in a perfect world, our liabilities and our equity will add to 600,000. Like I said, in a perfect world. I'm not quite sure this is it. Anyhow, accounts payable, and I refer you back to, I'm going to the adjusted trial balance from page 153 of your text. That's where all of these numbers have come from. So let's take a look at our liabilities. We have accounts payable, 96,000. We have interest payable of 20,000. Salaries payable of 19,000. Unearned fees, 30,000. Long-term note payable, and again, this is due outside of 1 year or one operating cycle. That's why it's long-term. And a long-term note payable of 138,000. Therefore, our total liabilities, when you add those up, assuming you do it correctly, it's 303. $303,000. Now, the equity's got to come up to 297 because total liabilities and equity have to equal total assets. So if we have $600,000 in total assets and $303,000 in total liabilities, we know that unless we screwed up, we need to have $297,000 of total equity. So let's take a look. Common stock, we have 20,000. Retained equity, sorry. First cup of coffee, guys. 277,000. Praise the Lord, another miracle. Total equity, 297,000. Total liabilities and equity, 600,000. That's part 35A, that's part 1. Part 2, which really is kind of not deserving of its own full part, is just asking you to take the profit margin. Well, the profit margin is asking you to compare a couple of things. It's asking you to compare the total revenues and compare them to the income. And when you do that, when you divide the net income by the total revenues, you come up with a profit margin of 17.2%. People tend to look at ratios and say, well, is that good? Is that bad? I don't know. I have to know what business the Chiara company's in, and I have to know what profit margins are acceptable and common in that business. Okay, 3.5a, parts 1 and part 2. See ya.